Hello, and welcome to season 3 of the You're an Asset podcast. I'm your host, Casey the Dollar. And on this podcast, we find out who is an asset in the financial industry and who is just an ass. Welcome back, everybody. Thanks so much for joining me. Season 3 has officially begun, and we have some very exciting stuff to talk about. Amazing guests coming onto the show, so make sure you stay tuned every week for a new episode. Without further ado, today's topic of the podcast is going to be how to set up an IUL for max cash accumulation. Whether you're an agent, whether you're a consumer, whether you're just interested to know about how these IULs can be set up correctly or set up wrong, this podcast is going to go through exactly what you can look for if you're a client to know that your policy was set up correctly, and if you're an agent, exactly what buttons you can press to make sure that you're setting up your policies correctly. The term properly structured is thrown around a lot, and unfortunately, there isn't a manual on how to properly structure an IUL. But I'll tell you, there really is a way to properly structure one of these policies if your goal is cash value accumulation. You might have even heard the term minimum death benefit max cash, because that's really the goal when we're purchasing an IUL or when we're designing one of these policies for someone. If their goal is to turn that cash value into an income or to be able to borrow from it later, we want to set up the policy to be able to do just that. And there are ways to limit the amount of cash accumulation we can have. So let's get into it. First things first, if you want to use the minimum amount of death benefit, the question you should be asking yourself or asking your agent is, what is the max contribution per year into the policy? Or what is the most amount of money that is going to be contributed each year on average into this policy? For example, that could be something like $6,000 a year, which is $500 a month. It really doesn't matter what that number is. What matters is that it's the most money the person wants to contribute on average into the policy. What I mean by that is 1 year you might put 6,000, 1 year you might put 3,000, and another year you might put 9,000. But on average, you're coming out to that 6,000. So determining what that max contribution number looks like, very important. Step number 1. And then you want to know, well, what's the minimum amount of coverage that you can buy for that max contribution amount? If you're an agent, to make sure that you're setting up the policy correctly, you want to be using what's called an increasing or a return of premium death benefit option from day one. If you're a client, you can look at your policy and see what death benefit option was chosen, and you want to see increasing or return of premium. That could also look like option B, switching to option A. Something that's also important to know is this policy structure is very particular to a long-term funding period, and long-term is described as anything more than 7 years. A 7-year funding period or more is going to need a death benefit option of increasing or return of premium to have the best results. So definitely look at your illustrations, look at your back office, find that option B or that increasing death benefit. Make sure you click it, make sure you see it on your policy, because that is going to be a key so that you know exactly how your policy was set up. Now, I mentioned that you might see switching to option A. Switching to option A means that the death benefit option is going to be switched when there's no more premium going into the policy. When you have a return of premium death benefit option, which could also just read as ROP, the policy itself is going to automatically increase the death benefit and then level it off so that when premium stops going in, the death benefit doesn't keep increasing. This is a really important part of how these policies are set up because if your policy is always increasing the amount of coverage that you have, that means you're always paying a higher cost of insurance. So you want to make sure that at some point, whether it's after year 7, on year 10, on year 15, on year 20, that death benefit option actually stops growing or even decreases when you take out a loan or when you take out income. So now we know how the death benefit option is chosen and why and where to look for it. Another way that you can make sure your policy has that increasing death benefit, that's also the minimum amount of coverage, is by looking for the guidelines associated with your policy. There are actually 5 different guidelines, but really the most important one is called the guideline level annual premium. This is the max amount per year allowed into the policy on average, the guideline level annual premium. Also, could be called the GLAP. The GLAP will be found in the illustration documents 100% of the time. When you see the guideline level annual premium, it should read as close to your contribution amount as possible. Unfortunately, that will look different depending on the carrier that you're using. When I set up policies that are max funded at $6,000, sometimes the GLAP is $6,005. Sometimes the GLAP is $6,100. The point is that max contribution amount, that guideline within your policy can tell you if your policy was set up so that you're fully funding it with the premium that you wanted to contribute. So if you check your policy and you see that you have an increasing death benefit, you have a return of premium death benefit option, and your guideline level annual premium matches what you wanted to contribute, your policy is going to be set up to have the most cash accumulation possible, and you're in good hands. Or you're doing well by your clients. Another way that we make sure an IUL is set up for as much success as possible is by diversifying the money that's going into the policy into different index options. An IUL earns interest by tracking the stock market or tracking certain index options, and you have choices within your policy. On a minimum, there's usually at least 5 different choices of where your money can be allocated within your IUL. Our recommendation is that your money is allocated into at least 4 different places. One of them should be what's called the fixed account. The fixed account earns a guaranteed interest rate. Power3 Financial's standard as a company is that we put at least 20% of the total premium into the fixed account so it can earn a guaranteed interest rate. The guaranteed interest rate may be something small like 3%, but we also have products right now that are offering as high as a 5.4% fixed interest rate. This is something that we do to make sure the policy is consistently returning every single year, even when we have a 0% year within our policy, meaning that the stock market crashed. Using the fixed account means that 100% of the time, you're going to earn money within your policy. You don't have to use the fixed account, but it's definitely something to consider when you're talking to your clients or when you're talking to your agent, because guaranteed interest within your life insurance policy is a way to make the policy more reliable. And if you're looking into insurance already as a place to put and grow your money, why not make it even more reliable and more consistent by taking advantage of guaranteed interest? Now, the other 80% of the money, what should we do with that? Well, most likely, you're going to have at least some portion of the money allocated to the S&P 500. Each product is going to offer different indexes that we call proprietary indexes. Proprietary index is just a newly created index for insurance products. Some of them have been around for 4 years. Some of them have been around for 10 years. It's going to be really important for you to understand how long an index has been alive, and then also go back and look at the actual performance of those indexes so that you're making an informed choice about how your money is growing. We would say that using at least one historical index like the S&P 500 is going to be a very important key to success as well. Because it's historical, we have a lot of data to look back on to show how the index is going to perform so we can feel confident in what we're going to see in the future. With a proprietary index, if we don't have much history, some people might feel like they don't want to use that index. As agents, we shouldn't be pushing new shiny indexes on our clients just because potential data, or what we call look back data, which is really just back tested data to show what it potentially could have done. Agents should be educating themselves about the options, about where they're diversifying their clients' money. And clients, you can do the same thing. Again, all of this information is inside the illustration, the historical data, the look back data. And if you can't find how long an index has actually be around, there's this thing called Google, and you can find out just from doing a quick Google search. Believe me, sometimes even we have to go on Google and find out how long an index has actually been around, so that when we talk to a client about why we've chosen a particular index, we have all the information. So we like to spread out the money in 4 different indexes, 3 that are tracking the market, and 1 that's fixed. This way, we're not putting all of our eggs in one basket. If one index doesn't perform, the other one will. Some of the indexes have different things like bonuses or high participation rates. Some have caps, some don't have caps. So choosing different indexes means that we can benefit off of everything that the product has to offer. This is also something that should be in your illustration 100% of the time. You can go and look at your illustrations, you can find the index options, and you can see the allocation. You want to see some kind of diversification. Agents, you should be taking this into your own hands and diversifying your clients' money. Clients, potential consumers of index universal life insurance products, you should be asking the agent you're working with, hey, what are my options for diversification? How can we make sure that the money is spread out, diversified? Because no matter which money product we're using or what account we're using to grow our money, diversification is always key. There are also a couple additional riders that I'd like to mention that can benefit the overall performance of your policy or make your policy more flexible and allow your policy to grow with you. One of them is called a supplemental term rider. A supplemental term rider is not available on all products, but if it is offered, you want to make sure that you consider using it, because a term rider added into your IUL can actually get you more coverage at a cheaper cost. This doesn't mean that you have to increase the overall guidelines of your policy and not fully fund it. The policy can be designed to still have your guideline level annual premium match your contribution. It just adds extra coverage at a lower cost so that ultimately the cost of insurance is cheaper and you get more death benefit out of it. The next one is called a guaranteed insurability rider. The guaranteed insurability rider is actually only available for people who are under 40, but if you're not under 35, it might not make sense to add a guaranteed insurability rider, because here's how it works. It's an added rider that you can put on a policy to say that you would like to increase the amount of death benefit coverage that you have every 3 years from ages 22 to 40, which is why I say that if you're 35 or older, it might not make sense to add it because you don't have very much time to increase your death benefit, but it could still be worth it. Now, how this works is if a 22-year-old gets a policy and in 3 years, they've decided, you know what, I wish I could add more money into my policy, or turns out I have a higher life insurance coverage need, they can use the rider that was added into their policy to increase their death benefit, give themselves more coverage. And that also means that they can add a little bit more money per year or per month into their policy. This is a great way for a young person to get a max funded IUL and not have to get another IUL in the future. This rider would allow them to grow with the policy, keep adding death benefit, and ultimately increasing their premiums when it made sense for them in the future. And if it doesn't make sense to increase the death benefit and use the rider, no problem. This rider is usually between $10 and $30 per year that already comes out of the premium that you're contributing. It's kind of a no-brainer. If you can increase your coverage without proving you're insurable, which is another important point, it's in the name, guaranteed insurability rider. You don't have to prove that you're in good health at the time of using the rider. The insurance company will just give you more death benefit because you got approved in the past and already have a policy. So there's multiple different ways that this can be used or why it would be important. And agents, I hope you're looking into these riders and doing the best that you can with the resources and tools that are available to you within the companies and within the products that you're offering. Whether you're a client, a potential client, an agent, or even thinking about getting into the life insurance industry, I hope this information was helpful. Hopefully, you have a way better idea now of how you should be designing your index universal life insurance policies and what to look for within your illustrations to know that your policy is set up correctly, your agent did right by you. And honestly, if you need help and you want to make sure, hands down, that your policy is going to be set up right, I know this place that you can go. It's called Power 3 Financial, and we would love to hear from you. The link to reach out to us is right below this video. I'll see you next week. Bye. The You're an Asset podcast is not giving financial advice. We are not licensed financial advisors, and our licensing is strictly in insurance products. The information that we talk about is specific to the products that we work with. We cannot guarantee that other agents will have the same product features that we discuss on the show.